everybody's reaction here. 215,000 jobs created in the month of March, Steve Moore. That's better than expected, although the unemployment rate goes up to 5%. Participation rate goes up. And interesting to see where the job growth was: healthcare, education, services, government, mining. Once again, we see declines in mining. What's your take?
Yeah, so decent number for sure. You know, this has been a slow but steady recovery, and this is just further signs of that. I want to make one general observation about what's going on kind of on a macro level with this economy, and this report confirms this. So where are we losing jobs? We're losing them in mining and commodities as the oil prices have come down. And I predicted this on your show for many, many months, that as those oil prices come down, that actually is going to lead to more job growth in other kinds of industries like restaurants, like retail, you know, like construction, and I think we're seeing that. So we're kind of moving away from the sector that carried the economy on its back for the last 5 or 6 years, which was the oil and gas industry, and now we're seeing the shift to other industries that are benefiting from low oil prices.
Yeah, Steve Cortes, your take. It's a little better than expected when you look at the number of jobs created, Steve, but it looks like it's pretty much in line with what you were looking for.
Right. No, and listen, I stick with my theme. It's good. It's not great. What worries me is the fact that and by the way, oil did very well in this first quarter this year. So I would have expected actually a better take from the manufacturing and from the mining sector because of improved commodity prices. We didn't get that. So what worries me, and I hear this a lot from Wall Street lately, is everybody says, oh, earnings are great once you strip out energy. Well, I heard a lot of that in 2000 once you strip out technology. I heard a lot of that in 2007. Well, once you take out banking, things are fine. So are things fine? Right? I don't think so.
Yeah. Gary Kaminsky, we got a market that is reacting to this number here. In fact, it is worsening. We see the market trading lower this morning.
Right.
Connect the dots for us.
Well, if you forget this number, the S&Ps are basically where they were 2 hours ago. Sort of neutral in terms of the number as expected. Now we're going to focus on what happened overnight in Japan, which was trading at significant lows, major correction over there in terms of what happened with their business survey and their sentiment survey. And so you had a week, if we look at the board in Europe. So I think that this was as expected in terms of the March employment data.
Okay, yeah, market's actually improving. Yeah, we are off of the lows, I just want to point out, for stocks. Oil has worsened, but stocks have improved.
We're essentially where we were on the S&Ps 2 hours ago, so I think this is a net neutral on the employment data. We can't say, going back to the Fed, we can't say that this number is going to have an impact one way or another in terms of a June move by the Fed.
Yeah, it's pretty steady, Jack Otter. We're bumping along the bottom. What else is there to say?
What the bond market is doing. If anybody has that number, I haven't seen it yet.
Treasury yields are up right now.
Treasury yields are up, Steve?
Yeah. Okay, so I think this is seen then as a good number. So
in line with what
is bad.
Well, Jack, in line with what Janet Yellen said earlier this week, which is that we will continue to monitor the data, i.e., we're possibly going to move again in June.
1.81% on the 10-year, up 3 basis points right now, Jack Otter.
One thing I would say about oil and gas, I mean, just because the price has ticked up a little bit, I mean, that's just going from
still low.
Insanely low to just a little bit low. So rig count is not going to go up. People are not going to hire in that industry until you start seeing supplies going down a lot.
So
that's absolutely true.
The job participation, which we were talking about right before the number came out, the job participation rate did jump up, which
63%.
Which is something that even the strongest critics of any good jobs report in recent months has said, wow, we're not seeing that tick up. It's moving a little bit, so that's something to point out. And hourly earnings.
Hourly earnings too, but yeah, the job participation rate since September has actually been growing. So to see 400,000 people enter back into the workforce, very positive sign. And even though we see unemployment tick up slightly, that's actually still a good sign because that's being driven by more people.
You know, the question is what took so long?
How many people? Do we have any idea how many people could potentially re-enter the workforce this year? Do we have any idea?
Millions, actually millions.
Exactly.
You know, it's millions of people that could enter, you know, that are not participating. Well, if you look at the overall, you know, population of people that are eligible to work in the United States, and then the actual amount of people that are only participating, there's a difference of, I don't have it in front of me, but over 50 million people.
It's I was going to say, I estimate the drop in the labor force participation rate has removed somewhere between 3 and 5 million people from the workforce. So there's still an upside here. Now, the point I was going to make is what took this so long? You know, we've been looking at these sort of positive jobs reports as the unemployment rate has come down now for 3 or 4 years, and the mystery has always been, Maria, why aren't people entering the workforce as they normally do during a recovery? This is kind of the stalled, delayed reaction. Wages are finally ticking up a little bit, and we're also seeing finally people re-entering the workforce, but we're still way behind where we should be.
Well,